Do we have the possibility of a recession soon? Let us find out in this video on different parameters and discuss it out whether recession is on anvil or not. Don't forget to subscribe the channel and enable the notification bell for updates. In order to assess the possibility of forthcoming recession, we will analyze it in three different parameters. First is the misery index. Second is yield curve, what the yield curve spread is indicating on this count. And then, friends, we will go to the price chart of 20-year Treasury bond rates so that we know what is the possibilities looking there in terms of bond rate and a long-term bond rate. Those who are beginners in this field, and if they are confused about what is misery index, yield curve, and treasury bond, etc., don't worry, friends. This channel is all set to inculcate the financial literacy in the minds of all beginners in the field of financial markets. So, friends, let me explain you one by one. Let us first understand what is the misery index. Now, in order to understand it very simply, what causes misery in our life? Especially, I'm talking about the economic misery. Misery could be on health aspect also. But I am today talking about the economic misery. One is the inflation rate. If inflation rate rises, what happens to us? We have to pay more for the things we buy in the market. So our cost of living becomes higher and higher, which impacts our quality in life. And second is the unemployment. If we are unemployed, our income stops. That causes misery. So misery index simply measures these two aspects. What is the prevailing inflation rate? As we are hearing that inflation rate is rising day by day, and Fed rate hike is being taken in different tranches in 2022 to control the inflation. And secondly is the unemployment rate. Now, unemployment rate is being tracked in USA by US administration since 1948. However, inflation rate has been assessed since 1913 because CPI measures, the consumer price index measures the inflation rate. Now, a recent survey in United States of America indicates that out of these two parameters, unemployment causes more misery in life than inflation rate. And that is true also, friends. To some extent, we can face the inflation. But if our income stops, what happens? More and more people will go towards poverty. And the recent survey in United States of America indicates that unemployment affects by an extent of 1.7 times in comparison to that of inflation rate. So presently the misery index is being calculated by a simple calculation. What is the inflation rate? And you add on to employment rate duly adjusted seasonally to arrive at misery index. But theoretically, if unemployment is affecting 1.7 times, this is my opinion. I'm not questioning the method of calculation. This is my opinion. If it affects by 1.7 times, then probably the weightage in misery index of unemployment rate should have been 1.7 times more to correctly assess the situation of misery which citizens are facing due to these two aspects. I hope, friends, that misery index aspect is clear. So misery index helps determine the average citizen is doing, how they are doing economically. Now, second element we are going to discuss is about yield curve to assess the possible recession forthcoming. Friends, yield means interest you get. It's as simple as that. If you recall, in our Hindi channel, we had made a video way back on 15th August 2019, when this channel was very, very new, hardly few months old. And at that time, we discussed about yield curve inversion and possible threat of recession and the bear market in the stock market. At that point of time, there was not a single case of COVID in any parts of the world. And whenever yield curve inverses, the possibility of bear market and a recession follows very soon. Let us always remember that yield curve inversion is a leading indicator, and it has been showing very correctly to a large extent, except 1 or 2 times it has failed to show the possible recession. However, the economy slowed down even then. And when we brought that video in August 2019, the people did not take seriously, especially from Indian space, because our channel was very, very new. We hardly had any followers at that point of time. Our followers did not touch even the baseline of 500 subscribers. At that time, we said that the possible bear market could be in next 6 to 9 months, and that happened in the month of February 2020. So everybody talked about the bear market coming forth and reason being attributed towards COVID, but yield curve inversion indicated way back in August 2019 when the yield curve inverted in UK and USA simultaneously on 14th August 2019. Now, what is yield curve? In order to understand very simply, those who are very new to the financial market, that when you go to the bank and want to open a fixed deposit of 20-year or 10-year, and somebody of your friends goes to bank to open a fixed deposit for next 2 years, who will expect the higher interest rate or a yield on the deposits in the bank? I would like you to comment in the comment section. Very simple. The person who is depositing money for a longer duration will always expect higher interest rate than the person who is depositing for a shorter period. So when the bond rates yield, when the bond rate yields for, say, for example, 10-year is yielding lesser return than the 2-year bond rate, the yield curve will invert. And that is the first indication of some problem in the economy. However, economy at that point of time will look like it is booming, like it did in August 2019. So it's a leading indicator. So how the chronology follows? First the yield curve inversion, and then the stock market comes into bear phase, and then recession follows. So even stock market is a leading indicator. Stock market is not economy. Let us not forget about it. I hope, friends, with this simple example, the concept of yield curve inversion is clear. And third element for the discussion today, to assess the possible recession in future, we will go to the price chart of bond rate. That is 20-year Treasury bond. Because whenever there is a threat of recession, the possible threat of the stock market coming in bearish phase. So what happens? People withdraw money from equity market and they try to park in bond market. That is why the bond is considered to be a good hedge towards your equity portfolio. Now, this means the equity market versus bond market, these two markets are inversely proportional to each other. If equity market will rise, the bond market will come down. But when the bond market shows a reversal, because technical analysis works in the bond market as well. When the bond market price chart indicates some kind of reaching out to the support level and possible reversal, then that could be the sign of, yield curve inversion happening, and then bond rate also likely to go up, then that situation is precarious. So the possible recession is there. The one good part is that whenever yield curve reverses or inverts, it takes time. It is not that the yield curve is inverted today and bear market will start right tomorrow. No, it takes 6 to 9 months to even 12 months. It gives enough time to us to take care of our portfolio. That is why, my friends, we have been cautioning you that only invest in those stocks who are fundamentally sound business. Because stocks of the sound business are like bouncing balls. They may fall, but they will recover eventually. But the stocks belonging to the poor businesses may not recover. They are just like falling knives. And falling knives, when you put our hands in falling knives, we are likely to cut our hands. So now let us go and discuss all these three aspects as to what is the possibility of recession in near future. Now we are referring to the US Misery Index since 1948 because it was introduced only in 1948. So historically what we see, it has touched the peak of 21.98% in June 1980, where there was a sizable contribution of inflation rate as well as the unemployment rate. But it is the historical high as of now. Now, presently, the misery index stands at 11.67%. What we can observe here is that when it remains at around 5 to 6%, it is quite comfortable. But it has been rising since February 2021 steadily. Now, if we check the employment data, then it is the contribution due to the inflation, not because of the unemployment in US. So if you recall that I had a discussion with Larry Williams' analysis of cyclic phenomenon of CPI, that is inflation rate, which is fast approaching towards the 5.5 year of cycle, which means that with rising interest rate in different tranches in USA, the possibility of Fed rate hike might control the inflation by the year end. So that is not a this index is not a very worrying factor because this contribution solely coming from inflation rate. Now let us check the yield curve inversion aspect of the forthcoming recession. Now we are referring to 10-year treasury constant maturity and 2-year treasury constant maturity. What we can see, whenever this curve inverted here, we can see in 1978 it inverted here, and then at that point of time you recall that the misery index was at a peak in 1980, and we had seen a very phenomenal bear market at that point of time, followed by major recession in the year 1982, and then friends, it again inverted here in March 89. We had seen the bear market of 1990, and recession followed in September 1990. So it had inverted here in February 2000. We had seen the bear market, and then friends, here it inverted in 2006, and the phenomenal bear market of 2008 followed by the recession in the December 2008 when recession started. In fact, the correction in the bear market ended more or less in 2009. And friends, in the recent time, we all know regarding the yield curve inversion that happened in August 2019, and your channel has made a video, of course, in the Hindi channel, because at that point of time, English channel never existed. So we had made a video and we had seen the bear market forthcoming in the month of February 2020. Now, what is the present scenario? The present scenario is not looking good, friends, because the yield curve spread 10-year versus 2-year is only 0.04. So it's a fast approaching towards the inversion. Inversion has not taken place, but the possibility of inversion cannot be ruled out, and that is my worry. Now let us have a look towards 10-year versus 3 months, because Once this inverts, it might take 6 months to 9 months time for bear market to start. But if we compare the 10-year versus 3 months, normally when that inverts, what happens? The bear market may come in a couple of weeks. Now we are referring to 10-year 3-month treasury yield spread. What we can see, presently it is comfortably placed at 1.8%. But can we see here it inverted in February, and within few weeks the bear market started. So we have to analyze the market with different parameters to assess the possible recession forthcoming or not. So as of now, there is no sign of inversion as of now, but we have to keep track on both the yield curves spread, like 10-year 2-year and 10-year 3 months, to be controlled in the stock market. Especially when we are dealing with the stock market portfolio, we must protect our portfolio. But even now we should be very cautious about selecting the stock which are from fundamentally good businesses. Now let us go to the price chart of 20-year treasury bond. Now we are referring to 20-year treasury bond ETF. Friends, what we can see here is during the bear market, see the rise in the price of a 20-year treasury bond, which itself indicates when there is a fear in the market, then the people take out money from the equity market and park it in the bond market, and hence it is a good hedge towards equity portfolio. Now what we can see in the recent time is there has been sizable correction in this particular price chart, and the price is fast approaching towards the demand zone, which is at 122 to 128 level, and we can see this trend line, which is a rising trend line. Price has taken support here, price has taken support, multiple support, price has taken support, and then we saw a jump of 2022 in this bond rate, and then finally it is coming very close to the demand zone, which happens to be the confluence of SMA 144 as well. So it might bounce back after taking support in this demand area. So we'll have to be very cautious, because there we have seen the misery index rising. Of course, there is not a contribution of unemployment aspect of it. And then we have seen the yield curve, the spread is hardly anything, especially in 10-year and 2-year spread. And of course, 10 months and 3 months is comfortably placed. So hi friends, let us take a very cautious approach in the stock market as well, because sometimes the major correction, when we see a pullback in the market, it could be a major pullback as also, and then we have to be very cautious to combine various kind of analysis in different parameters, and including the stock market, various indices in the world, so that we keep an eye as to whether the forthcoming recession is an offing or not. And if it is not coming, it's a good news. If it is coming, then we have to be very cautious and take a timely attempt, like we did in the last time when we got the first signal in August 2019. We were well prepared to get out of the stock market in 2020, and we were cautiously monitoring the stock market at that point of time. I hope, friends, it might have given you the value addition, little longer video, but it's always worth teaching to the stock market or financial market beginners, so that they are aware of the things, they learn the things, they keep the track of each and every aspects of the financial market, so that they are well in control. Thank you very much for watching. Looking forward to meet you very, very soon. Don't forget to subscribe the channel and hit the notification bell, so that you are always updated with upcoming uploads on this channel. Thank you very much.